Good afternoon, and welcome to this month's Risk Readiness webinar. I'm Ann Adams, and I am the Senior Product Manager at RMA for Business Solutions. We're just going to give it another minute or two before we fully launch, but today's webinar is the latest installment of Credit Trends and Commercial Lending, Credit Risk Navigator, presented by Tom Cronin. And as usual, if you have any questions for the speaker, please submit them using the Q&A featured at the bottom of your screen, and we'll address as many of these questions as we can at the end of the presentation. So Tom, it looks like the participant number count is slowing down. So I will say, I think we can start whenever you're ready.
Okay. Well, thanks, Ann, and Happy New Year to everybody joining us today. That's probably the last time I can say that. This is our annual review. If you've been with us before, you know this is my favorite. You'll see a number of charts today comparing December 23 with December 22. And as former RMA Chair Ed Schreiber of Zions Bank once said, month-to-month comparisons are questionable. 6-month looks begin to give you an idea of what's happening, but year-over-year comparisons give you the best feel for the true trend. And that's what we're going to try to do today. And as we've gone through the past year, we've heard from many of you that your bank was taking a hard look at what sectors to keep and what sectors to shed. And I hope the results of this annual review will help you successfully go through that process. So the source of our data, as always, is the Credit Risk Navigator. We're now into our 21st year of collecting data. And you'll see a number of slides today that go back through prior to the recession and then COVID. I did want to, before we jump into the actual results, we did have a question from back in November, the last webcast. So in November, I had reviewed the concentrations webpage, which is what you see here. And at the end of the webcast, we received a question via the survey. And the attendee wanted to know if we had an example of how a bank actually used this webpage. So I have a couple of slides that I'm going to show you here where I've captured what one of our Credit Risk Navigator banks actually did with their concentrations. And I've adjusted the amounts a little bit just to protect everybody, but you'll get a pretty good idea of what was done. So the bank we worked with conducted what I call a 3-step process. Step 1 was to identify the top 5 industry sectors for their bank, and you see it here. So 23% of their portfolio was in real estate, 13% finance sector, et cetera. And these 5 categories amounted to almost 60% of their portfolio. So they knew they got a pretty big chunk in just 5 sectors. The next thing they wanted to do was to fill in this next column, market percent and NPL, to get an overall feel for how these industries, whether the sectors were better than worse than average. So as an example, if you look at 53 real estate, you see the percent non-performing is 0.65. And then down at the bottom, the overall percent performing for the market is 0.91. So 53, obviously, that's 0.65 is better. And we color coded that green. 52 finance falls in the same. 42 wholesale is about average, so that went red. And then at the opposite end, 51 and 54. So 51 NPL non-performing is 1.34, way above the market average. So we colored that red, and the same with professional services. So what they took from this is that they had, of their 5 top industries, they had 2 of them that were in pretty good shape, 1 that was about average, and 2 that were, from an industry standpoint, not too good, or had high NPLs. So the last step, which is on this page, was then to go back and say, okay, how are we doing in these markets? Could be that it's a bad market, but we do pretty well. So they put in their percent NPL. And if you start at the top, again, for 53 real estate, their non-performing loans were basically non-existent, 0.07%. So their conclusion was Real estate is a decent market and we're doing really well, so we don't need to touch that. Finance, on the other hand, they were a little bit above at 0.33. And so they're like, okay, not quite sure what to do with that. We'll just monitor that a little more closely. Wholesale, which was an average performing industry, they were doing pretty good in, so they were happy with that. And then we came to the bad part. Unfortunately for them, 51 and 54, which are the most risky sectors for the market as a whole, they were doing really bad, particularly information. You see information there at 4.25. So almost 4 times the market average. And then professional services at 149, not as bad as 51, but definitely above the market average. And so those two sectors were red. And it was those two sectors that the bank that we were working with decided to cut back and de-risk. And just one more thing on this. So a lot of people will say, well, okay, fine, I'm in a risky sector. All I got to do is cut back. What's really the financial impact of that? So what I've done here is pulled up 2 bond ratings and the interest rate for bond ratings. We know from talking with S&P that if you're in a risky sector, they will downgrade you a notch. So this is showing you what happens if you have a $150 million bond. If you're AA rated, it's an annual expense. The interest rate is 5.25. Your annual expense about 7.9 million. If you're downgraded a notch, your interest rate goes up 40 bips and your interest expense goes up $600,000. So there's a definite cost to having, if we go back a second, things like this, where your information, which is a risky industry, if you're not doing particularly well in that industry as well. So definite cost to that. Okay. So now let's move on to the results. We're going to start with the C&I loans. And by way of definition, C&I are business purpose loans to private or public companies with sales usually north of $1 million. Loans to these borrowers are manually underwritten and credit scored, and loans secured by owner-occupied properties are C&I. All right, so we want to start or launch our first poll question, Ann, if I could get you to do that.
Sure.
All right, so here, we're looking for your forecast. We do this pretty much every year, try to get a feel for what you're thinking. So what are your C&I loan? And I specified here C&I, we're going to talk about CRE later on. So this is just C&I. What are your C&I loan growth projections or expectations for 2024? Negative, basically flat, little bit of growth, modest growth, 3 to 5, or significant growth. And we'll take a couple of seconds to see how people think.
Okay, looks like most everybody has responded.
Okay. Let's see. So 5%, 12, 35, 47, and 2. All right. So most people are moderate to slight growth. Interesting. Okay. So let's move on. So here's our performance trend. We have the delinquencies, the gold 30 to 59 days past due, the green 60 to 89 days past due, and the percent non-accruing. You might notice that in 2023, I was showing percent non-performing, which was non-accruing in 90 days. The 90 days past due are basically so small right now that I didn't think it was worth even adding them in here. So that's why you're seeing just percent non-accruing, just in case you were wondering. And then throughout most of 2022 and into the first few months of 2023, we were seeing non-accrual levels close to all-time lows. You can see there that the levels there were back to where we were like 07, 08. Then starting in May of 23, non-accruals started to rise. And year over year, we've gone from 0.51 to 0.70. And we're seeing similar results with the short-term delinquencies. It was not 0.19 as of December 22, and it's now 0.5%. And medium-term delinquencies are up, but not as significantly as the short-term delinquencies. So we thought we'd dig in a little deeper to the non-accruals and the short-term delinquencies on a couple of slides, next couple of slides, to see what's going on. But there's definitely a rise or a decline in the performance, rise in the non-accrual, whatever, how you want to put it. So let's look at non-accrual trend by industry. So this chart has December 22 in the blue and December 23 in the gold, percent non-accruing for each 2-digit NAICS code. Now in CRN, we can go down to the 6-digit, but we'll stay at this elevated level just for now. And of the 24 2-digit NAICS sectors, we're seeing year-to-year increases for 17 of the 24 sectors. Most notably, we're seeing increases for 32 manufacturing, 45 retail, and 51 information. All three of those are up at least 3 times versus their December 2022 levels. Within 32 manufacturing, it's subsectors of plastics and millwork. Within 45 retail, bookstores and electronic shopping. And then within 51, software publishers and motion picture production are having problems. And the only sector with significant improvement is 11 agriculture. So here's non-accruing trend by geography, and a quick note. When we say geography for C&I, we're talking about the location of the company. So a loan to FedEx would be tagged as being from Mississippi. And when we look at the non-accruals by geography, we're seeing year-over-year increases in every region. So the problems are, as you saw on the previous page, 17 out of 24, and then for every region. So nobody's escaping the increase in non-accruals. You see the big jump for the Mid-Atlantic. When you drill down into there, we see that it's primarily in Pennsylvania, my home state, and New Jersey. And then from an industry standpoint, it's all the manufacturers, so 31, 32, and 33, 42 wholesale, 52 F&I, and 54 professional. And the other thing I'd make a note of is that almost all of the increase in non-accruals in the Mid-Atlantic was for loans that were participated or syndicated. So something I think you need to be aware of. I know a lot of times banks do participations and syndications and might not do their complete due diligence. And it's looking like that's where most of the problems are. All right. Okay, so this chart's a little busy, so I'll take a second to explain what we have here. So this is delinquency by industry, and you have for each industry sector, so 11, you see a column for December 2022 and a column for December 2023. The blue is the short-term delinquencies, so 30 to 59 days past due. The gold is the medium-term delinquencies, 60 to 89 days. And there's a lot of movement here. And I counted at least 12 sectors with what I call big or significant increases, with the ones with the most notable change, as you can see there on the left, is 32 manufacturing. And within 32 manufacturing, the largest subsectors that are seeing increases in delinquencies are for printing and plastics. And in December, short-term and medium-term together for 32 was at 0.25%, just below 0.25. Fast forward to December 23, and it's now at 157. So quite a jump. If you go over a little bit more to the right, pardon me, You also see that 54 professional had a significant change, not quite as severe as 32, but still up. This was due to subsectors accounting and computer system design, and it's gone from 0.51 in December to 126. 51 December of 22 to 126 December of 23. But a lot of movement there. You can see again what we saw with the non-accruals. We're seeing here a lot of movement in a lot of industries. So here's the same style chart. This is delinquencies by geography, as we did non-accruals by geography, past dues this time, and a couple of observations. First, you'll see that for every region, December 23 combined levels are higher than the December 22 levels. Again, just what we saw with the non-accruals. Every sector's, every region's up. Second, the short-term past dues in the Northeast, so almost in the middle, in the blue there, have soared. Just almost gone, 3-4 times. And then the highest non-accrual region, which we saw prior, the South, has one of the better delinquency levels, suggesting that the problems in the South have already occurred or been recognized, and that you would not expect any of these loans in the South to end up being on non-accrual, as opposed to what you're seeing in the Northeast. So we're going to wrap up performance with a new look. This is a new table, and we're calling this our industry level performance scorecard. And we're ranking each sector for short-term delinquencies, medium-term delinquencies, and then percent non-accruing on the far right. And those cells that are in green, those are the best quartiles. Red is the worst quartile, and then yellow represents the middle two quartiles, and we'll call that average. A couple of things to see here. 32 manufacturing is all red. We've mentioned this already, a couple of times already. You'll see some other industries like 54 professional services, 2 out of the 3 are red, and then the other one's yellow. For green, 44 retail, which is the cars sellers, that's 2 of the 3 are green. So you get a feel for kind of the direction these are going. All right. So what we want to do now is launch our second poll question. All right. So this return, again, this is specifying C&I. So what are your expectations regarding your 2024 C&I charge-offs? Do you think they'll be less than 23, about the same, or more than 2023? And again, this is C&I, not CRE.
Okay, looks like most of the responses are in.
All right. So 9% less, 55 about the same. All right. So nobody's expecting much improvement. That's not surprising. Okay. So now we'll move on to credit quality. Pardon me. When a bank joins CRN, we map their native borrower risk ratings to the RMA 10-point scale. And on that scale, 1 through 6 are pass, 7 is special mention, 8 is substandard, 9 is doubtful, and 10 is loss. And 7 through 10 are collectively known as criticized, 8 through 10 are classified. And so over the 20 plus years of CRN, you can see 2 distinct credit cycles. The first was 08-09, as a result of the recession, and then again, another cycle in early 2020 as a result of the pandemic closures. At the beginning of this year, the weighted average risk rating for CRN had improved from the pandemic high and was at 4.39, which was very close to the service all-time service low. But since then, same as what we saw with the performance data, credit quality has slipped and now stands at 4.59%. So let's take a look at some of the details of what's happening on the next couple of slides. A quick explanation, if this is the first time you've joined us, of what I'm doing here, and you'll see the word distressed. As we've analyzed CRN data throughout the services 20 plus years again, we have found that a large percentage of the sixes, which are the low passes, migrate to the criticized. So here we've added low pass, which is in the blue, to the percent criticized detail. So the gold is special mention, substandard, the green, et cetera, et cetera. To get a more, we've done this to get a more complete picture of credit quality. And we call this combination distressed. And here's what we're seeing. The two cycles we just saw are playing here as well. We almost eclipsed 50% during the recession, and we're up again with COVID, but not as high, but in the low 30s. Earlier this year, we reached a service low of 17.9% after the high in the 30s. But now we're seeing another pronounced increase, and we're just about at 25%. So if this is your measure of credit quality, your anticipation is going the wrong way. I think this is interesting that we just did the poll question, and most of you are expecting either, I'm looking at it real quick, charge off the same or a little bit higher. So this kind of jives with what we think is going on, or what's going to happen. So let's look at the distressed volume by trend by industry. And again, December 22 versus December 23. And all but 3 industry sectors are seeing an increase year over year. The 3 that improved were 23 construction, 45 retail, and 92 public administration. The sectors with the highest negative changes, so the worst credit outlook, were 31 manufacturing, 49 transportation, and 51 information. And of those, the one that I found really interesting was that 45 retail. Actually, you can say it declined. It might have stayed flat, given what we saw with performance, the decline in performance. I would have thought that would have gone up a little bit more, but sometimes what we find is that people have already accounted for the poor performance. So here's distress volume by geography. Every region's up again, with the exception, and with the exception of the Western Midwest, every region is now above 20%. A year ago, only one region was above 20%. So you can get a feel for how things have turned here. The Eastern Midwest has actually gone from being the best region to now the worst region, dropping the South into the number 2 position. And when you look at the Eastern Midwest, when you look at the NAICS codes, just about everything's up. I had a really hard time going in trying to say these are the ones that are bad. There were a lot were up. Most substantial increases we saw were for 62 healthcare, and we'll talk a little about that when we get into CRE, 42 wholesale, and another manufacturing, 33 this time. So you're seeing a lot of softness with manufacturing. From a size standpoint, with the increase in the Eastern Midwest, the biggest increases were for participations and syndications again, and then loans greater than 25 million. So something, again, I think that you should probably take a look at what you're doing. Okay, now we're going to move on to CRE. A quick definition. For CRE, we follow the interagency guidance that basically says if more than 50% of the loan repayment comes from the rental or sale of property, that's CRE. You'll also hear what we call CRE referred to as investor-owned properties. And we want to start with a poll question here as well. All right. So this is our loan growth expectations, but this one is specifically related to CRE. And again, if you remember the definition of CRE, this is investor-owned properties, not owner-occupied properties. So we're looking, are you thinking negative loan growth? And this is overall CRE, so not a specific segment. Negative, outstandings flat, just a little bit of growth, 1 to 3, modest growth, 3 to 5, or are you looking for big growth, 5% or more? So. And we'll see what you think here.
Okay, looks like most people have responded.
All right. So 11%, 20 flat, 41. So almost 70%, 3% or less. So people, and this quite a bit different from what you're thinking on the C&I side. All right. And this, as you'll see in a second, that this seems to make sense. Okay. So here's the CRE performance trend. Again, short term, 30 to 59 days past due. Medium term, 60 to 89 days past due. And then the dark blue line is non-accruing. And you'll see about a year into the pandemic, almost just a little bit above where the 21 is, the percent non-accruing reached 1.28%, which is the highest it had been since almost 2014, 2015. From there, it began a gradual decline. And by the summer of 22, we were at 0.78%. But since then, it's been slowly notching up, and now it's back above 1, sitting at 1.09%. Short-term past dues, year over year, about the same. Same with the medium-term past dues. So we'll look at those a little bit later, but I thought we'd take a look at the non-accruals in a little more detail. So on this chart, we're showing the percent non-accruing for the top 8 property types. And when I say top, that's the largest outstandings in the Credit Risk Navigator database. So let's start with the good news. Over the past 12 months, the percent non-accruing for lodging has dropped just about in half. The impact of the COVID closures continues to fade, and lodging hotels are doing much better. On the flip side, and this will come as no surprise to anybody, I hope, non-accrual level for office properties has soared. At the end of the year, we heard that national vacancies were nearing 20%, as the return to office appears to be stalled somewhere around the 50% range. Again, different depending upon what parts of the country you're in. But in addition to office, and I mentioned this earlier, we're seeing some elevated levels for healthcare as well. Again, while they're nowhere near the levels we're seeing for office properties, healthcare is up, and you'll also see that multifamily has almost doubled. Again, very small, so I don't want to make too much of it, but that's a doubling down there. So office obviously dominates the news cycle, but I would say you really need to pay attention to healthcare and multifamily, particularly with multifamily, because of there's a lot of press about number of units coming online and rent growth not really being there. And so we this might be a forecast of what's to come with multifamily. So here's non-accruing trend by geography. And a little bit different from C&I. CRE, the region is based on the location of the property. Doesn't really care who the builder is, just where is the property located. And if you compare this with the C&I non-accrual by region chart, when you get this document, you'll see some differences. Notably that the increase in non-accruals is not across the board or across the country. Here you'll see improvement in the Northeast, where the improvement in lodging is more than offsetting declines in performance for office and multifamilies. The Western Midwest is better, as again, the improvement in lodging is more than offsetting declines for performance in offices. But we're seeing tremendous negative changes for the South and the Southwest. And within those, particularly for the South, there's a big increase in the non-accruals for offices. There's some for healthcare and some for retail, but most of that gold bar you see for the South is offices. The Southwest, again, a big increase in offices, also some increases for health, not as much as office, but definitely more than any other subsector. So you're starting to see some regional differences with offices and lodging. We know if you've been with us over the past 2 or 3 years, you knew the Northeast was high because they had a high concentration of business hotels, DC, Philly, New York, Boston. Those are doing better. Northeast is improving, but now we're seeing problems in the South and the Southwest. Real quickly, we'll look at past dues by property type. And again, I'm going to kind of go through this a little bit quickly because the overall look, the overall past due has kind of been the same. Here we have short-term past dues are up for all types, except surprisingly office. So that's the dark blue. They've actually retreated a little bit. And the medium-term, changes are not quite as one-directional. For example, in a positive direction, you see health. So that's the gold has improved. Lodging obviously has improved. In a negative direction, where the gold has gotten bigger, the gold bar has gotten bigger. We're seeing that for mixed use properties, residential properties, surprisingly, and retail properties. Probably the first hints of any issue we're seeing with residential and retail. Here we had delinquency by geography. And when I first started looking at this, I was trying to look at, since this is our annual review, I was trying to look at what are the year-to-year changes here. And I was having a hard time. So I stepped back and took a different look. And those of you who have been involved in real estate for a long time have heard the axiom that real estate's all about location, location, location. And that's what I saw here. Especially with the short-term delinquencies, it depends upon where you are. The biggest columns are on the left-hand side of this chart, belonging to the Mid-Atlantic and the Northeast. The West is close behind, but the Mid-Atlantic and the Northeast are having the largest delinquencies. In the Mid-Atlantic, there's still problems with lodging, and we're seeing now some issues with multifamily. In the Northeast, it's healthcare, multifamily, office, and retail. And in the West, it was industrial properties and multifamily. And again, I point out the multifamily and the health as two sectors that aren't getting a lot of attention because of office, but we're seeing some slippage there. So now, pardon me, this is our property type performance scorecard. Again, the green being the best, the red being the worst, and the yellow being the middle. And when I look at a scorecard like this, I'm not necessarily looking to see property types with solid reds or solid greens, although occasionally you do that. I'm really looking for overall patterns. So you do see a solid green there in industrial. That's by far the best property. The mixed use and retail are basically all yellow, are all yellow, so they're basically average performers. Office and health have 2 out of 3 red, so they're the worst performers. Multifamily and residential, mostly yellow, so average again. And lodging has 1 of each, which to me is kind of saying, you know, they're just recovering and you're seeing varying things going on with them. So this is here for you to use, get an idea for how these 8 property types are performing against each other when you look at delinquencies and non-accruals. All right, so now we're going to launch our last poll question. And again, this is going to be regarding CRE. And it's, what are your expectations regarding your 2024 CRE charge-offs? Less than this past year, about the same, or more than 2023? And we'll give you a couple seconds. Right. 3%, 53, 45. All right. So I just flipped back to what you said for CNI. And so CNI, we were saying 36% more than 23. Here we're saying 45. So you're expecting CRE performance, a CRE charge-offs to be worse than CNI, which I think that's a reasonable expectation. So here's our commercial real estate weighted average risk rating trend. And right before the pandemic hit, you see there right in the middle of this chart, the CRE weighted average risk rating hit a service low of 4.7%. But before the end of 2020, CRE weighted average risk rating had climbed to 5.17. Similar to what we've been seeing throughout today, as COVID restrictions eased and things got back to, I'm not sure if you call it normal or whatever you call it, weighted average risk rating improved to 4.89. That was in August of 22. But again, it's been rising throughout most of 2023. And the 5.24% that we're seeing at year end 23 is the highest we've seen for CRE since 2014. So let's take a look at what's happening. So once again, we're looking at distressed, and just a reminder, when I say distressed, it's low pass and criticized. So 6, 7, 8, 9, and 10 on the RMA 10-point scale. The overall trend here matches what we saw, what we just saw with the weighted average risk rating. We're now approaching 40% distress levels. Those are levels we saw right after the COVID impact, but not since 2013. Over the past year, one of the differences here, though, is over the past year, we're seeing a larger percent of low pass. So low pass has gone from 19% at the beginning of 23 to 27%, as the uncertainty of high rates and inflation has caused many banks to reassess their portfolio. And most of the changes in sixes is due to increases in industry and multifamily, not office. So as you'd expect, this is distressed by property type. As you expect, 6 of the 8 major property types have higher distress levels, December 22 versus December 23. Only lodging and residential have better levels. Office has almost doubled, is just a shade below 60%. And I had to think about that numbers for a second. Let's say that well over half of the portfolio of office properties are rated low pass or worse. It took me a second to actually think of how significant that is. Healthcare and industrial have climbed above 40% as well. And what we're seeing in healthcare, it's a combination of problems with doctors' offices and hospitals. Matter of fact, in my local town newspaper today, they were talking about shortage of nurses at hospitals. Post-COVID, a lot of nurses quit. And so you're seeing hospital expenses rise with inflation and less people to employ. So healthcare is having an issue. And then on the industrial side, as best as I can determine, this is because of the excess inventory for industrial properties. If you remember when COVID first hit, within 6 months or so, everybody was shopping Amazon and online, and warehouses were being built as fast as they could. And now, I don't have the exact figures, but I saw that the percent of e-commerce has basically stalled. So you have a lot of warehouses that were spec warehouses that are now possibly not going to be able to be filled. All right. Similar, you see the bump in multifamily. That's because of excess inventory as well. Not so much the new inventory that's coming online, but the Class B properties, if you would, where people are going to leave and go to the newer properties. So a lot of issues here, if you would. And then distress by geography. And once again, every region saw an increase, December 22 versus December 23. Every region is now above 30%, and 4 of these regions are above 40%. A lot of that has to do, if you look at the South and the Southwest, a lot of that has to do with the office properties, but it's more than just that. And for example, you see the highest sector or highest geography now is the Mid-Atlantic. The biggest change there was for multifamily properties. So that's 2023. And I'm going to, before we start the questions and let you get into the survey so you can tell me what you think and what you want to see, I want to leave you with this chart. Not to put a downer on it, but I think this is just kind of an indication of what happened last year. You can see very, very slowly things deteriorated for both C&I and CRE. And I have a feeling, I have no idea what's going to happen in 2024, but I think it's going to be very interesting for a number of reasons. First of all, we're going to find out if higher for longer interest rates lead to a recession, or if the American economy will continue to be very resilient and we'll see the soft landing that people are talking about. We'll see if the Fed will lower rates as predicted, if and when. There are still a number of geopolitical issues impacting the world economy. And of course, it's a presidential election year. Presumably, given the results of New Hampshire, we're going to see Biden versus Trump round 2. But all those factors are going to play into what's going to happen here. A year from now, are we going to pull this chart up and see that non-accruals continue to rise and some sectors get into significant trouble? I don't know, but you can see the direction things are going. And I think you'd be very prudent to take a good hard look at your portfolio and see, what's going on. All right. So Anne, I'll turn it back to you and open it up for questions.
Yes, we do have a couple questions already in queue, and do feel free to just add to the list, and we'll take them one by one. So first is CRE non-accrual healthcare properties would include nursing homes, assisted living facilities, etc. Correct?
That is correct. Yep.
Okay. Next question is, how do you explain the non-accrual rate for C&I is relatively low in the South, but the distressed loan ratio is relatively high?
So this is one of the things we discuss here at AFS quite a bit, where you'll see the difference between a risk rating and the actual performance. And what we have found, mainly from talking to banks, is that a lot of times the performance measures turn first and then the ratings follow. Some banks have a policy where they will update the ratings only on like a quarterly basis or an annual basis. Other banks update them as problems occur. And so that's what we're seeing here, is that a lot of times you'll see the stress or the risk ratings will be a little bit behind the actual performance.
Gotcha. Next question is, for CRE offices, can you distinguish between Class A and Class and B/C?
We do not have the ability to do that. Nope.
Okay.
Sorry.
No.
that would be good.
And then the last question is also, I think we just answered as well, as does healthcare include assisted living and nursing homes, et cetera? And we did say yes, but it just prompted me to question myself, in the sense that you did call out that a lot of what you are seeing is more doctors' offices and hospitals. Does that mean that you are seeing some stabilization with assisted living and nursing homes, or is it just kind of bundled into something else?
No, so early on in COVID, most of the healthcare issues were for healthcare assisted living, nursing homes. If you remember, there were a lot of deaths there, and a lot of people just stopped going. Families moved their elderly people out of those and put them in to adult day facilities. In the last year or so, we've seen that stabilize. And I apologize, I don't have the exact percent, but I think I saw that the vacancy levels have pretty much leveled off. And now what we're seeing and what we're hearing is that it's hospitals and doctors' offices that are having problems, primarily because of the skilled care, the nurses, the technicians that were overworked during COVID have quit and not come back. And there's a shortage of personnel, and you got to pay up to get those people. And so that's really putting a crimp on the bottom line. That's what we're hearing.
Got it. Thank you. Another question. Have you seen any evidence that spreads have expanded in any loan categories or sectors?
So by spreads, I assume they're talking interest rates. And that if you would send me that, we don't have anything on spreads in the Credit Risk Navigator, but I do have some access to that through another colleague. So if you would shoot me an email, I could respond. Pardon me, see my email here. We could respond to you through that, or through him, sorry.
Great. At this point, that is the end of the questions, unless there's anybody typing. I think we have covered them. So we'll give it another second or two.
Okay.
And as always, if there are other questions, certainly feel free to reach out to us and we can address them offline. And in some cases, questions prompt content. So your feedback is always really helpful.
Yep. Yeah, and the survey that comes at the end here, if you fill that out and if you have some comments in there as what you like to see or what you thought was valuable, what you didn't like, and what you would like to see, please put that in the survey or in an email to me. I've changed quite a bit of this presentation over the years based on what I'm getting out of that survey. So it's something I do read and react to.
Great. Well, thank you. Thank you again, Tom. And as always, for your insights and sharing with us. And thank you to everybody for joining us today. We look forward to having you in the next upcoming session. So for now, this will conclude our webinar. And again, please take a moment to complete the survey. It's really, really helpful to us. Thank you and have a great day.
Thank you.